Motor vehicle tax deduction rules can be confusing, so here's how to claim yours the right way. If you don't know the rules, you could be leaving money on the table, or alternatively, you might be risking an audit. In this video, you'll learn the two main methods that the ATO allows you to calculate and claim. You'll learn common mistakes to avoid, including fringe benefits tax traps, and finally, a step-by-step framework so you can apply this to your own situation. Let's dive in. And for our clients, keep an eye on your December client-only newsletter. It will contain a handy checklist with every vehicle and situation so that you can easily determine your vehicle tax deductions. Now, the ATO defines a motor vehicle as a car, ute, van or similar vehicle designed to carry less than 1 tonne and fewer than 9 passengers. Anything larger like trucks, buses and vans, and also utes that have a carrying capacity of over 1 tonne, these all fall under completely different rules. There are two main methods to claim motor vehicle tax deductions in Australia. The first is the cents-per-kilometer method, and the second is called the logbook method. Let's break them down. The cents-per-kilometer method is the simplest method. You can claim up to 5,000 business kilometres each year at the ATO set rate. For 2024-25, that rate is 88 cents per kilometre. For example, if you travelled 5,000 kilometres by 88 cents, you could claim $4,400 as a tax deduction. You don't need an actual logbook, but you must be able to show how you work this out. Diaries, client appointments, delivery records, that type of thing. And the travel must be for business and generally cannot be to and from your usual place of work. Next, let's take a look at the logbook method. This takes a lot more effort, but often gives a bigger deduction. You keep a 12-week logbook showing business work versus personal travel. That percentage then applies to all car expenses for the year. You can use a paper or digital logbook. Expenses include fuel, repairs and servicing, registration and insurance, depreciation up to the car limit, and loan interest or lease payments. Now an example. If you have $15,000 in total car costs, by 60% business use, you have a $9,000 claim. Next, we'll consider cars versus commercial vehicles. Here's the thing, not every vehicle is treated the same. Cars designed to carry less than 1 tonne and under 9 passengers, the depreciation is capped. Commercial vehicles like vans or utes designed to carry over 1 tonne have completely different rules. Next, let's look at depreciation. This trips up a lot of people. The ATO sets a car limit for depreciation. For the 2024-25 year, the amount is $68,108. So even if you buy a car that's $90,000, you can only claim depreciation on the amount up to $68,108. Commercial vehicles like vans and trucks and large utes aren't subject to this cap. That's probably why we see so many large dual cabs on the road. If you spend $120,000 on, say, a large Ranger, and it has a carrying capacity of over 1 tonne, and also the carrying capacity for the load must be more than the carrying capacity for the people. And there's a way to work that out. But if you qualify in that sense, you can potentially depreciate the full $120,000. Next, we'll look at GST. Remember, if you're registered for GST, your deductions are net of GST. For this receipt, the deduction is $93.98. Here's something really interesting. Some electric vehicles qualify for 100% tax deduction and fringe benefits tax exemption if provided to employees or their associates. This can be a really tax-effective option for small business owners and directors. But remember, cars above the luxury car limit don't qualify. So be sure if you're looking at this to ensure that your car is below the luxury car limit. The car must be new and 100% electric, so hybrids don't qualify. Check with your tax advisor before purchasing to be sure that the car meets the requirements. And look, there is currently some indication from the government that they might remove this very soon. Let's take a look at the records that you need. For the cents per kilometre method, You need evidence of how you've calculated your kilometres. For the logbook method, you need to keep a 12-week logbook, which might be valid for 5 years. You also need to record your odometer reading at the end of each year, and you need to keep all receipts for expenses. One client, Lisa, ran a consulting business. She drove everywhere but didn't keep a logbook. She thought fuel receipts were enough. If we used the cents-per-kilometer method, she would have missed out on over $3,000 in deductions. After speaking with us at her tax planning meeting, she managed to prepare a logbook in time for June 30, and she didn't miss out on the claim. Here are some common mistakes that you should avoid. Claiming 100% of the costs when the car is used privately, forgetting company FBT obligations, not updating your logbook at least every 5 years, and commuting confusion. Home to regular office is private, not deductible. Trips to clients or sites are deductible. The fear of an ATO audit is real. Nothing's worse than wondering if your claims will hold up. But when you have the correct records and you're making the correct claim, you can relax. You know that you're claiming every dollar you're entitled to without the risk. Now for a quick note that this is general advice only. Everyone's situation is different, so always check with your tax advisor. And if you're one of our clients, we'll go through your car claims with our next complimentary tax time meeting. And don't forget to like the video and subscribe. Also sign up for my free weekly business tips. The link's in the description. I'll see you next time.